Hey folks, this is David McKnight, author of The Power of Zero. In today's video, we're going to take a closer look at how people are using permanent life insurance as a retirement tool, particularly when it comes to creating a buffer against market volatility. There's been a growing interest in strategies that allow you to access tax-free dollars in retirement, especially in years when the market takes a hit and you want to avoid drawing down your stock portfolio. One of the more traditional approaches to this concept incorporates whole life insurance. It's been around forever. It's steady, it's predictable, and for many people, it's become part of their broader retirement strategy. Now, let me be clear right from the start, I'm not here to throw whole life under the bus. In fact, I think whole life has some legitimate applications, especially for people who are risk averse and are looking for guaranteed steady accumulation. But when it comes to efficiency, specifically using a cash value life insurance policy as a volatility buffer or a tax-free retirement income stream, there's another option that simply does the job more effectively: Indexed Universal Life, or IUL. Let's unpack why. First, let's talk about the role both policies can play in a retirement plan. Whether you're using whole life or IUL, the idea behind a volatility buffer strategy is to pay for your living expenses out of your cash value life insurance in the years following a down year in the stock market. This gives your stock portfolio a chance to recover before you take further distributions, and this act alone can increase the sustainable withdrawal rate on your stock portfolio from 4% to as high as 8%. It's a concept I discuss extensively in my books, The Volatility Shield, Tax-Free Income for Life, and The Guru Gap. So yes, whole life can work in this context, but it does come at a cost. Whole life is built on a guaranteed chassis, which is great if you value certainty, but that guaranteed structure comes with some trade-offs: lower internal growth rates, typically in the range of 3 to 4%, and less loan flexibility. When you borrow against your cash value in a whole life policy, you're typically going to pay interest. And depending on the policy design and the insurance carrier, that net cost of borrowing, the difference between what your policy is earning and what you're paying on the loan, can start to erode the value of that strategy over time. Now contrast that with Indexed Universal Life. When structured properly, the IUL has historical returns of between 5 and 7% net of fees. And a few IUL carriers now offer guaranteed zero-cost loans. That means you can access your cash value in retirement without having to pay loan interest, which gives you more flexibility and more efficiency when using it as a source of income. So again, it's not that whole life can't work as a volatility buffer. It can, but it's important to recognize that you're paying more through lower growth and higher borrowing costs to get that buffering effect. In the long run, that means you may need to divert more money away from your stock portfolio to fund the policy in the first place. You're taking money that could otherwise be growing between 8 to 10%, and you're locking it up in a policy that may only net you 3 to 4% over time. And because the growth is slower and the loans aren't cost-free, you'll have to spend down more of your stock portfolio to compensate. And this could force you to run out of money much faster than you ever thought possible. Let me bring all of this to life with an analogy. If your goal is to shield your retirement portfolio from market downturns, whole life is like taking the scenic route. You'll get there, but it'll cost you more time, fuel, and money. IUL, by contrast, is like taking the express lane. Same destination, just faster, cheaper, and more efficient. That doesn't mean the scenic route is wrong. Some people prefer it, and for their risk tolerance and financial goals, it works. But if efficiency matters to you, and if you're trying to increase the likelihood that your money will last as long as you do, then Indexed Universal Life is the superior alternative. Now, let's do a bit of a deeper dive on loan provisions. When you borrow money from your whole life policy, there is a net cost of borrowing. That could be anywhere from 1 to 4%. And if you don't pay that interest back, the company will subtract it from your cash value. And that can ultimately bankrupt your policy. That means you've lost your cash value and your death benefit. Some IUL policies, conversely, have wash loans or zero-cost loans that make accessing your money more predictable and sustainable. Okay, now let's tackle the issue of growth potential. Whole life is designed to be consistent and conservative. The growth inside an IUL, on the other hand, is linked to the upward movement of a stock market index. And should that index ever go down in a given year, they simply credit you a zero. That makes IUL a safe and productive accumulation tool that's ideal in the volatility buffer context. The index component of the IUL is what allows you to capture that extra 2 to 3% more over time than the whole life policy. And for your volatility buffer to work, you have to have accumulated between 3 and 5 years of living expenses by day one of retirement. And the enhanced growth and the IUL means you'll have to remove less money from your stock market portfolio to pull that off. Now let me be clear again, I have nothing against whole life. If you've already purchased a whole life policy and it's been working for you, that's great. This isn't about regret or criticism. It's about understanding your options moving forward. What I am suggesting is that when it comes to retirement income and the volatility buffer concept, the IUL is more efficient and effective. It gives you higher growth potential, more favorable loan features, greater efficiency, and more flexibility, all of which are critical in a retirement landscape where taxes are likely to rise dramatically and market volatility is here to stay. If you want help designing a tax-free retirement strategy that takes all of this into account, head over to davemcknight.com and click on the Connect with an Advisor button. I'll connect you with someone within my Power Zero network that has been trained, vetted, and qualified personally by me. And if you've enjoyed this video, be sure to click like, subscribe, and the bell so you never miss a new episode. If you have any questions or comments, feel free to drop them into the comment section below. I respond to every single one of them personally. This is David McKnight. I look forward to seeing you on the next video.